At the beginning of August, one of the biggest credit reporting agencies in the world downgraded the U.S. credit rating from its AAA status to AA+. Only a few days before that, the Federal Reserve increased its base rate again, continuing the pressure on interest rates and borrowing costs in the U.S. These two big financial news stories have real implications for the economy in general, and for those of us interested in housing and real estate, the question of how this will affect the broader housing market and mortgage borrowing costs are really important ones. That's what we're going to talk about today. We'll hear what the experts are saying, and I'll give you my top prediction for what's coming in the housing market. I'm Chase Hansen, your DFW Realtor. I'm a real estate agent serving the greater Dallas-Fort Worth area. If you find these videos helpful or learn anything new, all I ask is that you hit the thumbs up button and subscribe. For home advice, you can also contact me directly through my email listed in the video description. I'd love to help you out. All right, let's talk about the economy and houses. This news cycle really seems like housing is getting hit by a perfect storm. It was a 1-2 punch for the Fed to raise rates less than a week before this credit downgrade hit. And we saw that in the real estate industry as mortgage rates reacted and rose a bit after each story hit. What that means for the average person when those mortgage rates rise is that someone buying a house right now will be paying more money per month with that higher interest rate, and it makes people thinking of selling choose to wait longer, which lowers inventory and contributes to the difficult market we've seen this year. So what are the experts saying? Many don't think the credit downgrade will have much impact on housing. The Treasury Secretary Janet Yellen said the credit downgrade is based on old news. And Zillow's senior economist Jeff Tucker said this: investors already saw the debt ceiling showdown and larger deficit forecast that this rating downgrade is based on, so those risks are already priced into mortgage rates. So the idea is that mortgage rates typically respond to something called the 10-year Treasury yield, and that Treasury yield factors in instability and risk in the market, and that was already factored into prices when Congress had its debt showdown a few months ago, so old news. But that's not the only opinion out there. Lawrence Yun, the chief economist for the National Association of Realtors, thinks the credit downgrade will lead to interest rates not being able to fall as much in the future, so mixed opinions there. We'll circle back and summarize what this means in a minute. And what about the Federal Reserve raising interest rates? Most economists seem to think that the Fed is done raising rates. Recent inflation numbers have come back good. The next Fed meeting at the time of this recording will be in late September, so they have some time to wait and see how their previous decisions settle into the economy instead of continuing to raise rates indefinitely, which sometimes has felt like they're just continuing to shoot without stopping to see what they've already hit. Right now, researchers at the CME Group are predicting an 86.5% chance that the Fed does not raise rates again at their next meeting. I personally think they will be done raising as well, especially now that other factors like the credit rating are in play. So what does all this mean? Well, the consensus from experts seems to be that the dynamics of both the credit downgrade and the Fed's rate hike have already had their effect, meaning mortgage rates are probably near their peak as I record this video. And although they change daily and there's no way to perfectly predict the future, the consensus from experts is that they should begin to settle and slowly fall the rest of this year, although they may not fall as sharply as previously expected, unless we were to enter a small recession, but that's a whole other conversation. But those rates fall because the Fed no longer manipulating rates to fight inflation will create stability that will allow those rates to start coming down, even if they don't lower the base rate. My prediction based on the info I've seen, I think mortgage rates will slowly decline on average over the next few months, and I kind of expect us to end the year in the low 6% range, so about a percentage point lower than we are now. Again, that's what a lot of the experts and researchers are forecasting, and then I think they'll continue to fall slowly but steadily over the course of the next year. I think this winter will probably be a fairly slow market, but not a standstill, which means an opportunity for those who want to buy while prices are a little bit lower before they start rising again at the beginning of next year. And I think next year, and especially next spring and early summer, we'll see a much faster paced buying market as people see interest rates drop some and decide to enter the market as the financial side of things frees up a bit for the typical buyer. So today we've seen the 1-2 punch of the US credit rating downgrade and Fed rate hike. We've heard some of the expert opinions on what that means for the housing market, and I've given you my prediction of how those things will impact normal buyers and sellers. If you're thinking of buying or selling a house, I'd love to help you get started. My email is in the description, or you can DM me on Instagram. I'd be happy to answer your questions. And even though I personally work in North Texas, I'd love to help you start the process and get connected to a local agent who can help you buy or sell when the time is right, wherever you are. Let's talk. Be sure to like this video, subscribe, and check out my other videos. Again, my name is Chase Hansen, a realtor serving the Dallas-Fort Worth Metroplex. Thanks for watching. I'll see you next time.